So I'm going to look at how many stocks you should own coming out of the segment from last week, as promised, and a simple portfolio build, the way that we recommend you build your portfolio. Let's start with what not to do, and we kind of just talked about this in this segment. That is something we call mass diversification. It's kind of the broken model. This is the basic model most Canadians deploy through their big bank advisors. There are some advisors that do it differently, but it's still by far the most commonly used method. It includes a mix of 5 to 15 plus mutual funds and ETFs. We see this type of portfolio from clients when they send us their portfolios on a daily basis. Now, each type of fund in this under this model owns, or ETF owns, roughly 50 to 150 plus stocks. Each fund then holds too many stocks and really mirrors the market return or the segment return they follow, but they underperform due to the high fees that they're charging you. And the portfolio underperforms, particularly under this model, when you include the roughly 1 to even 2% advisor fee that we've seen on some of these type of portfolios. Of course, we were talking about just one fund there. This is just one of many 5 to 10 to 15 plus funds that you own. This is extreme over-diversification for those trying to beat the market, but I wouldn't just take my word for it. Let's look at some of the best investors of all time. Warren Buffett says diversification is for protection against ignorance. It makes little sense if you know what you're doing. To hammer this point home, I'll reference Bill Gross next. He co-founded PIMCO, managed one of the largest funds in the world for decades. He said, do you really like a particular stock? Pick 10% or more of your portfolio on it. Make the idea count. Good investment ideas should not be diversified away into meaningless oblivion. So your question now should become, how many stocks should I hold in my portfolio? Well, let's address that. According to modern portfolio theory, you come very close to achieving optimal diversity about adding about the 20th stock to your portfolio. It's actually just under 20. So diversification, it makes sense to a point. Generally, we don't want you buying 2 to 3 stocks, even if we or you have put in all the research in the world. This is too much company-specific risk. As an extreme example of this, if you were to hold stock in Tesla, that would be considered a CEO-driven company. If its CEO, Elon Musk, heaven forbid, were to pass away, that would likely have a dramatic negative effect on the stock. Of course, the funny thing here is, since Elon bought Twitter, this is becoming less and less valid. I'm kidding, but you kind of get my point. You cannot mitigate away this company-specific risk. If Tesla is one of 2 to 3 stocks you own, if it's 1 of 20, you can help handle it. It can help allay that company-specific risk in your portfolio. On the flip side, there's absolutely no point in buying 50 to 100 plus stocks and creating a complex fee-heavy portfolio that mirrors the market. This is what we like to call, wait for it here, boom, diversification. As Brett said, finance is not funny, but that's about as funny as we have it for you here today. How do we recommend you build your stock portfolio? Well, we say we want you to take control of it. If you want to beat the market, you cannot just be the market buying 10 to 15 plus equity ETFs or mutual funds. If you just want to perform at the market, you can probably buy 3 low-cost ETFs and call it a day. If you're trying to beat the market, we want you to create your own simple equity portfolio, building under a model that we would call focused diversification. And how do you do this? Well, this is key. Build a 15 to 25 stock portfolio gradually over a 12 to 24 month period. Do not buy all 25 stocks in the first week, month, or even year. Traditional advisors will buy, like I said, 5 to 15 plus, ETFs and funds right when you step in the door. This crystallizes your entry point. If you're near a top and face a significant decline, it can take a significant amount of time to recover if you face a significant correction. Remember, if you have a 50% loss in a security, or heaven forbid in your portfolio, you need 100% gain to get you back to just even. While no strategy is perfect, building over a 1 to 2 year period reduces the risk of short-term exposure to short-term market corrections. This is a strategy we have employed for decades with clients. It provides you flexibility to add to new positions as new opportunities become available, and they always do. The process, if you became a client with us tomorrow, or you want to start building your own portfolio tomorrow, you want to start with 3 to 5 initial positions. What we also provide for if you have that other part of your portfolio in cash sitting there, you can use Keystone's quarterly cash ETFs report, where you'll find in that portfolio currently paying about 4.5%. Individual options to park that cash. We update this quarterly with recommendations to get you paid the highest dollar on the cash that's on the sidelines. All clients have access to this report. Then you can add 2 to 3 new stocks per quarter every 3 months as new information and research is released. In practice, this is an example of what a portfolio structure of a portfolio using our research would look like, that focused diversification strategy. Essentially, 7 to 10 stocks deployed in our 3 core areas of research: our Canadian mid to small cap growth stocks, core Canadian dividend growth stocks, and core US growth stocks. I put together a simple allocation example here. We can see a $500,000 portfolio, 20 stocks with equal weighting. So that just means take the 500,000, divide by 20, you got 25,000 in each individual security as your full position to start. So how impactful? We talked about last week how 2 to 3 stocks can be tremendously impactful if they are great stocks in your lifetime. Just to show you an example of this, once again, how impactful one great stock can be and why, we recommend building a portfolio in this methodology with focused diversification. This is a $500,000 portfolio. If you invested 15 years ago when we recommended Boyd on an equally weighted basis, so if you had 25,000 in Boyd at that time, today the stock would be worth $3.18 million. Just one stock is worth nearly 7 times the entire original portfolio. All other 19 stocks could have gone to zero. Of course, that's not what we're seeing happen in our portfolios, and we wouldn't see that going forward. But this portfolio would still be in excellent shape. Of course, we are also looking for growth in a solid percentage of the other 19 stocks as well. But it shows you the truly amazing power that a great stock can have in your portfolio. And you can see here the effect that, as well, the returns are even better if you use Hammond Power as an example here. So hopefully that now gives you an idea of how many stocks you should own and how to build that simple portfolio. In our webinars and seminars that we do at least twice a year, we have far more detail on how to build that, but I thought I'd give you a quick overview of that today.
Yeah, I think that it's great. Just to go over to give people an idea, another thing that we talk with clients about is just the layering into positions and how it can be beneficial. As again, it's very difficult to actually time the market if we like a business, but think that maybe there are near-term headwinds. Again, maybe starting with a half or a quarter position. And I like the analogy where I ended up writing an article a few years back where, just like drinking a freshly brewed hot cup of coffee, you can avoid getting burnt by just taking a few sips at first rather than, swigging it all down, essentially. I really like that analogy where it allows you to be nimble, essentially kind of mitigate both the business's operational risk and also the price action risk in the market. But again, giving you some exposure. Like I wrote in that article, I ended up getting, burnt by trying to time on Expel. Again, this was years back. I was definitely more of a green analyst. I still am to some degrees, or to some degree. These guys would probably agree with that. But I was waiting for Expel to pull back to $14. If I would have just even put a couple grand in it, which would have been a half position for my portfolio, I would have went 3x, 4x on that money rather than sitting on the sidelines and being a sad investor while I watched the stock continue to run. So that is just on top of what Ryan was saying, another thing that investors can look at when they are building their portfolio. maybe taking a quarter or a half position, depending on, the fundamentals of the business or what we're anticipating from the business itself.
Yeah, I agree. That's, one of the things we talk about, and we recommend to clients when we make a recommendation on a stock. There are times where we have a half position, quarter position,
Yep.
whether it be a buy, that sell at times. We had a company that we recommended in the fall that exceeded our expectations, was up about 140%. In about a 6-month period. And we had originally, our original thesis behind it was if it could do that over a 3-year period, and it actually exceeded that, this would be a good, it's not that it's a bad company, but, we took half our position out, and now we have still a full position, because when a stock goes up more than 100% on your original position, you've doubled, more than doubled. You still have a full position, but you've taken all your initial capital risk out. And now we can just feel comfortable holding that company for an extended period of time, as long as they continue to deliver. Yeah, and with your analogy with the cup of coffee, as long as you know that that cup of coffee is going to be a good cup of coffee, you can have that initial small sip and get involved. It may be too hot, like the stock price may be a little bit too high, but you do need to. You don't want to be too cute.
Exactly.
And if you found a really good company, even if you think it's slightly overpriced, it's probably good to start nibbling away at it.
And I was trying to be too cute on a great business, Expel.
Aaron always says you are pretty cute. So
yeah, that's what he does say.
And just really tying in the,
of course, being very sarcastic.
Yes,
yes. That's fair. Go on. Sorry, Brett.
Yeah.
Were you going to call me cute too?
Yeah. Unfortunately not. That shirt doesn't do it for me today.
Yeah. But this has escalated quickly.
On the really reweighting strategy and diversification, the benefit of you doing yourself, you're able to have that approximately equal weight portfolio, or near equal weight, depending on your stock price movements. That is more diversified. So even if you're looking at ETFs, you'll find equal weight ETFs are more diversified. So if you are doing something for diversification, when you're buying these 100 plus, let's take the S&P 500, for example. Right now, you have 32.4% in information technology. So those are your big players, your Microsofts, your Apples, your Googles, and so on. That's in that category. That creates concentration within that sector, which actually lowers diversification by your normal market weighted strategy. Versus equal weight, you don't have that. But the issue with equal weighted ETFs, since they're constantly rebalancing perhaps that 50, 100 stocks or more, the fees end up accruing quite quickly. And since they are ETFs, they're not really thinking about the individual companies. You still have those poor performers. And since those poor performers, they lower in price over time, and then they're re-equal weighted up higher, you end up getting a higher weight of poor performers. So you can't really do it in an ETF form, where if you're doing individually what we like to do on a somewhat equal weighted, we're not going to say exactly equal weighted, you really can get that diversification benefit while you're also getting that concentrated returns. Yeah. You get best of both worlds in reality, where ETFs, you can't really do that due to how they function.
It's a good point.